The Deputy VP Research at SBICap Securities is joined us in the studio. Morning, Mahantesh. Thank you very much. Well, what's the scene looking like? And your in-house research is indicating we can get a lot worse before things trough out?
Probably yes, because we will have a lot of FII outflow that will happen, because what we've been observing is that in the US markets or developed markets, there's a lot of ETF redemption flow that is happening, and that is not going to stem so soon. Probably it will take 1 month, 2 months more until we have clarity on what the Fed liftoff is likely to be. So irrespective of whether the stocks are fundamentally looking attractive, markets are looking attractive, ETFs will just sell. So in such a situation, the momentum is for the downside. So from a valuation perspective, the markets were attractive even at 8,200 levels, because we were just at about 13 multiples forward earnings, FY17 earnings. We are today at perhaps 12 times FY17 earnings. So it's been a cheap market in this entire downfall that we have seen, and the downfall is attributable to the huge FII outflow. Thankfully, the domestic mutual funds have been supporting the market, but we really don't know how long will that continue, because if you have rupee depreciation happening, you have weaker earnings, and you have therefore weaker GDP, probably the savings will not get drawn into equities.
Okay. Mahantesh, are you anticipating a worse September as opposed to what we saw in August? August was FII flows, which we've seen at a record level since many months or maybe a couple of years as well, and not to mention we lost around 5 to 6% in the series itself. Will September be worse?
Okay, let me answer this question in two parts. FII flow, will that be worse than August? Probably not. We will still continue to see some amount of FII outflow, but hopefully we will not see, and this is purely based on hope, because if August was a record of 6 years in terms of monthly outflows, then probably September may not be another record month. The second part of the question was about whether we will see Nifty levels going down from here on. So probably a 200-250 points cut seems visible in this FII outflow kind of momentum. So that's what we are anticipating. But like I said, from a valuation perspective, the market is attractive. This is the time to really go out, and if you have the money to put in value kind of stocks.
That's what I was coming to. I guess much of the market, the funds in particular, would be fully invested as their mandates would be. So if the first question, if there is incremental cash, where will you deploy them? And for those invested, what would you churn out of? What would you churn into?
So what we are advocating is you have to be in what we call as India-centric stories. India is a great economy. It's growing probably the fastest. There is a point of debate in terms of whether China is faster than us, but I'm just saying that from a momentum perspective, India GDP growth will be the fastest in the world among large economies. So if that is the case, we have to look at picks within what we call as India-centric businesses, and businesses which appear very attractive in terms of valuation. There may be weak earnings growth in the interim period for these companies, but if the valuations are cheap, why not look at such India-centric kind of businesses? So whenever we say India-centric business, two sectors really crop up. One is infrastructure and one is the banking space. So it goes without saying that these are go-to kind of sectors, and probably depending on the valuations that you take, you might look at some of the names are attractive.
Okay. Well, I'll just come back to those two sectors in a minute. We just spoke with the management of Marico and as well as Motherson Sumi. Now, Motherson Sumi was extremely confident of the sales in Europe. That's 85% of their market. And Marico, they did 6% volumes in the first quarter. They were confident of 8 and were even looking at 8 to 10. So, are these areas that you will look at, auto ancillaries, suppliers to Europe, which is where the fluffing out has happened? Or
the two companies that you named are quite frankly are aberrations. Okay, they do not necessarily tell you what is the underlying trend. In fact, most of the auto ancillaries exposed to the European market, either you are supplying from onshore plants there in Europe or offshore plants in India, are in trouble because the euro as a currency collapsed this year. So unlike the normal behavior of currency, which tells that rupee will depreciate against dollar, so you have, if you're an export earning company, you will get better profits. The companies exporting to Europe didn't see that build up in at least the first 6 months of this year. We don't know what's likely to happen in the next 6 months. So from that perspective, the currency play is to us is quite weak. So wouldn't really pick companies who are exposed to the European economy just because the volumes are shaping up well. The currency play is actually going to be negative. So having said that, as far as the Marico is concerned, we are talking about rural consumption, semi-urban consumption growth. But there are contrary indications that you can see. Look at the two-wheeler numbers reported this month. Hero MotoCorp is minus 14%.
Yeah.
TVS is minus 2.5% in the domestic market. That tells you that the rural economy is not really shaping up well enough. And the GDP numbers we saw were quite weak. Monsoons are 12% below the long period average. So what I'm trying to tell you is, from a rural standpoint of view or a semi-urban standpoint of view, some companies may be exception in terms of seeing their particular basket of products really doing well vis-a-vis the general market behavior, which is very cautious. These are defensive plays. One has to again come back to valuation. So what we have been trying to say is, let's look at what was the valuation of some of these companies in the last 5-7 years. What is it now? What is the departure from that long period average? If the departure is significantly on the downside, probably this is a value pick. You may have an interim period of slow earnings growth for the company. But yes, you can surely get into this stock with a 12-month, 24-month kind of horizon.
Mahantesh, just a quick question. We had a cabinet approval, which is unofficial right now. It's source-based information at this point, that private companies can possibly participate in smaller oil fields, possibly in terms of bidding. Would you have a view on that? Any companies that are interested in the oil and gas space?
No, not really, because we've been traditionally knowing that when it comes to oil exploration, for example, offshore is extremely expensive. Onshore is probably simpler, but there the challenges are about land acquisition, the challenges are about environmental clearances, etc. I don't think this policy is going to move the needle by much.
Okay. We'll have to leave it at that, Mahantesh. Thank you very much for dropping by. That's Mahantesh.